Good morning, everyone. Welcome to Monday. Welcome to Monday Minutes. Let's kick off this week and get right into it. First and foremost, a big thank you to Ira Jersey and Will Hoffman, Bloomberg Intelligence, their FICC Macro Matters podcast, for including us on Friday, to talk about the Fed, to talk about rates, the balance sheet, the macro outlook, certainly the direction of rates here going forward. Quickly going back to last week, Chair Powell reiterating the fact that the Fed will and can begin to lower rates here in 2024, saying they need a bit more of good information, not better, a bit more of good information, and at the same time saying they're getting close. Now, keep in mind the audience that he was speaking to very much in favor of lowering rates here. So we take him at his word here. We take the Fed at their word that they are on course here. The market gravitating now toward that June, July time period, perhaps May a little bit priced in, but more so June. Let's talk about inflation. So CPI week. Tomorrow, we do get the CPI reading. Now, keep in mind the Fed does follow PCE inflation versus CPI, but these CPI days have generally produced very outsized moves in terms of the rate market here. But let's look at the tail of the tape in terms of the PCE readings, starting in January of 2023, the month-over-month readings. 0.51, 0.36, 0.34, 0.31, 0.29, 0.17, 0.12, 0.10, 0.33, 0.15, 0.09. The Powell pivot in November of 2023, 0.14, 0.42 last month. The bottom line here is the Fed needs those month-over-month numbers to be in the range of 0 to 0.2. If you go back and you look at where the chairman pivoted last year, you could see those numbers moving back more in the range and in line with where we were for a couple of decades before the pandemic hit, which produced inflation in the range of 1.5% to 2%. So the bottom line here is the timeline for the Fed here could potentially get tight if these numbers don't reverse and start to come down again. Fed Governor Waller saying recently that he would need to see now a couple of more months of good inflation readings to validate the fact that what we saw last month was a hiccup. So tomorrow's number does matter. Given where we are rate location-wise here, we have certainly for our clients favored adding duration on backup in terms of yield concession, the consolidation, the beginning of 2024. So in 2-year space, let's call that 470 to 475. In a 10-year space, we've targeted that 435 level, both which have held. They've worked out nicely short term. But in general, we would say the market is really lacking direction here. So if we look at 2-year yields in and around these levels where we moved, given that uptick in the unemployment rate on Friday, we certainly seem, I would say, a little vulnerable as we head into this CPI reading tomorrow. The other thing is this notion of the neutral rate too, right? Which has come up as of late, and it's come up really over the last couple of months. The chairman saying that the Fed is restrictive here, which we agree with, and we do think they left room to come down on the way up with those outsized 75 basis point rate hikes. If they were just to shave 25 basis points from each of those outsized hikes, we get to a small easing cycle in the course of 2024. Let's call it a recalibration. But in general, the real economy does perform here like that neutral rate is slightly higher. But even with that, even with a slightly higher neutral rate, if you look at where the Fed is right now, there is still room for the Fed to come down here and still be restrictive with even a small easing cycle, which brings us to next week. The debate really, I think, will be two cuts or 3 cuts in 2024. The S&P from December indicating 3 cuts. We think the Fed will stay with 3 cuts. The unemployment rate projected at 4.1 in the December S&P, now with the unemployment rate ticking up here on Friday, giving the market a little bit of an alleviation that that unemployment rate is in fact moving in the direction of what the Fed is projecting and also indicating a softening of the labor market here. On the ground this week, it's all about CPI. Tomorrow, we get PPI. We also get retail sales. We're going to be paying close attention here to the high-frequency data going forward in the weeks and months ahead. as we formulate a timeline for the Fed to potentially cut rates in 2024. Wishing everyone a great week ahead. I'm Greg Faranello. I'm head of U.S. rates for AmeriVet Securities.